Stocks continue this historic rally. I'm going to break it down today. I'm going to show you an indicator I haven't really shown very much, kind of a tease of a class I'm going to be teaching as part of Market Scholars, a technical analysis class. I'm going to introduce you to another technical indicator that sheds quite a bit of light on the kind of move that we're getting, and kind of highlights some how a stock can make a really crazy move, which takes us to our trade idea with a strategy that I've shown you before, but not in this way. So let's go ahead and get started. Today is Friday, January 19th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those that are watching us for the first time. Keep coming back for more day after day so that you can know what's going on in the markets, what you can do about it. Subscribe to my YouTube channel by clicking that red subscribe button right down there below the video. Also click that thumbs up icon right next to it. That lets me know that you liked it, that you want me to do it again on Monday. Also scroll down further, comment on anything that stands out to you from today's video. Finally, I've highlighted one of the links in the description of the video down below as well. The one I've highlighted is a link to join my email subscription list. I send out an email every day with time-stamped hyperlinked summaries of every segment that we cover in this video day after day, so make sure you're on that list. Follow me on Twitter for more content that I put out in addition to these videos to stay relevant. I share with you relevant topics that we talk about day in and day out here, so my address is up there at DavidSettle42. Remember to like and retweet tonight's Market Outlook tweet. Finally, join the Market Outlook community on Facebook. There's almost 800 of us. We're a few off from 800. If you haven't joined, join this weekend, and let's continue this discussion of what we talk about in these videos with others that are watching this with you. All right, well, let's take a look at the S&P 500 first here with the market forecast indicator. And of course, I mean, look at this move. Again, counting that first day because it's like less than 2/10 off of 50th percentile, and it was an up day. So 1, 2, 3, 4, 5, 6, 7, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 days now, 12 technically above. And again, 7 to 12 is like the typical range when you're at the beginning of an intermediate trend. And you know, this intermediate trend continues, and you know, we're getting close to 5 months. 5 months over here, because see, this is where it started. Pretty much on the last day of August, so we get to the last day of January, and most likely will. I mean, because it doesn't come down below 50 that fast. We're looking at 5 months of a strong, bullish intermediate trend. Quite the rally here. So that being said, you know, we got that long intermediate rally. We have a long near-term rally. I mean, this is one of the biggest near-term. This is a logarithmic chart, right? So this is one of and what that means is it shows moves on a percentage basis relative to back here. Because again, you know, we went from 2,700 to 2,800 a lot quicker than we went from 2,600 to 2,700 and 25 to 26. But things are different, right? It's a different percentage because it's getting the 100-point moves a smaller percentage as we go higher in price. So keep that in mind when you look at this. I mean, all these, like, if you look at this intermediate run that we're on right now, at the end, probably closer to the end of an intermediate trend, we are now up. The second number from the right up here at the top, underneath the S&P 500 index. This is percentage year, so it's an annualized yearly percentage. So on this near-term run, we're up 138%. Annualized. The second number from the left is absolute, so 5%. Over 5% gain on this current near-term run. Let's go to like one of the earliest near-term runs that we had. Let's do this one because that was a really long intermediate run too. So from this intermediate run at the beginning of the intermediate trend up until here, because so that pullback brought the near-term line down. So you can see that move, the initial thrust of this intermediate trend, right? That because usually you get a really good near-term run right at the beginning. That one, which lasted 24 days, and that's 24 total days, not just trading days. But that was a long time and that was a 3% move, a 3.25% move. So 62% annualized. Remember, we're up 5% right now. And then there's this one right here. This was a good intermediate rally, pretty decent move. You can see, and by the time we got up to the open here, and then that pullback brought us down. You know, that was a 3.5%, well, a 3.6% move. So 98% annualized. And then let me reiterate. We are up now 5% on this near-term rally, 138% annualized over 21 days. This is not a new intermediate rally that we're on. This is a very mature intermediate rally. So, you know, and we talked about at the end of an intermediate run, you expect volatile near-term volatility. So big ups, big downs, lots of ovals. Well, we were getting lots of ovals. We're not getting lots of ovals now. The ovals being where the near-term line peaks above 50 and drops below 50. You get a lot of ovals at the end of an intermediate rally. We're not getting a lot of it. We broke out to the upside, and again, we've, you know, very similar to over here at the end of that. Oops, not 2 days, 2 years. At the end of this intermediate rally, you can see right, where was it? Right here. So we ran up, lots of ovals, and we broke up to the upside. And then after that break up to the upside, which finished with a flourish, that was a big volume day, big trading range. That's what started. You know, and I don't think we've had that kind of flourish day yet because, yeah, we've had some volatility and bigger. The moves, the ranges have been getting smaller, and the volume has been getting smaller the last couple of days, which is actually a good thing. It's starting to grind, right? And it's setting up the potential for this divergence. You can see lower highs on the near-term line compared to higher highs here. Now, you know, we're looking at a move down to 27.75 as a target of that divergence. And then breaking 27.75 will be, okay, now the trend has the potential of changing. And we've had a few extreme lows on the momentum line back here in December, but we've overcome that. We haven't had one since. So, you know, strong trend, but just remember, this isn't the beginning of a new trend where we expect 1 to 3 months. We're still in a very mature trend, and that maturity carries risk. Doesn't carry enough risk to say don't follow the trend, but it does carry enough risk to say manage your risk on any new positions. Manage your risk on your current positions. Your risk on your current positions are those profits, because remember, you keep your stop orders below support. You know, and as we move away from support, we're walking a tightrope that's a lot higher. So we have to manage our position. You don't want to move your stop order above support because you're going to get whipped out on a normal move. But what you do is you want to say, okay, let me start taking off risk by reducing my position sizes on new ones, and then taking profits by reducing position size on existing positions. All right, let's take a quick look here at the Dow Jones Industrial Average. They're all going to look very, very similar. They're all on extreme moves. S&P's at all-time highs. The Dow Jones Industrial Average, not quite at an all-time high. Its near-term line starting to pull back. You look at the NASDAQ Composite here, and you can see all-time high for the NASDAQ. Divergence setting up there with a target at 7,200 based on the low point between these potential highs. This would be a potential because the near-term line hasn't pulled back yet. And then finally the Russell 2000 breaking up to a new all-time closing high, not above the upper shadow, that short upper shadow there, but trending up here, and of course bigger divergence setting up on the Russell 2000, because again, there's the peak associated with this one here, and we're already above that now. So and the bottom for that 1575. So you can see the lows for this divergence in terms of a target aren't very far away. So we're not going to trade to that target because that'd be extremely counter trend. But what it does tell us is once you break those lows in between, then we've got the potential for a trend change from this intermediate posture again to a weak bearish posture. Any posture change from what is now currently strongly bullish will be first to a weak bearish. So don't go all bearish once the intermediate line drops below 80. That's not a sign to say, okay, let's back up the truck here. It just means, okay, we're getting this pullback. We're getting that exhale finally. And because the inhale was so large, don't expect a relatively large exhale, but will be large only because that this intermediate run has been so big. It won't be anything earth-shattering. It will seem that way, but again, only because the rally has been so big. If you're going to have big rallies, you're going to have big pullbacks. That 38% Fibonacci retracement is 38% of whatever that run was. The bigger the run, the bigger 38% is. All right, so let's take a look at the long-term chart. And again, it's so extreme, the fact that we're up to 150 points between the 50 and the 200-day moving averages. The 200-day moving average at 2550 essentially. The 50 at 2700. So quite the large move. Of course, it's going up. Both lines are going up. We are well up above both lines. And again, remember on a percentage basis too. We are the gap here between the 50 and 200-day moving averages as a percentage of the current price is bigger than this whole rally since 2009 bull market that we've been in. So very big move. A little bit of a hanging man candlestick pattern that we've got developed here. We've gotten this before, and it led to a little bit of some weakness over a 3-week period that brought us back to the 50-day moving average. We weren't quite so far up above, but you can kind of see, what happened there. Remember, long lower shadows aren't nearly as bullish as long upper shadows are, or bearish, excuse me, as long upper shadows are. But it is a bearish candlestick pattern, just not as bearish. So, grain of salt, right? But still strong long-term momentum to the upside. You can see the MACD on the daily charts up above 30 points. So the 8-day moving average is up above 30 points. And remember, the 8-day moving average the price has only been below the 8-day moving average one day during this whole this whole rally we've had here since about mid-November. So it's crazy. It's unbelievable. It's crazy how bullish this has been. And of course, we haven't been below the 17-day moving average except for one day right there during this whole intermediate rally in mid-November, and we came right back above it really quickly there. And the lines had converged. You can see the lines had really converged by mid-November, and now obviously diverged back up here. And remember, and I'll point this out again, we never, that we've diverged. We don't ever get big bearish moves until these lines converge again. So you usually got to come down to zero, closer to zero, before you get significant moves and you get any kind of intermediate low point. We're obviously going to get an intermediate low point someday, right? It's going to happen. As it may not be during the Trump presidency, but at some point in time, we are going to get an intermediate low point. But it won't be, this crash until we converge again. And the higher up we get, the longer it takes to converge. You can see, you can converge pretty quickly when you're, only 10 points up above. When you're 20 points up above, it takes a little bit longer. You can see here, this one took a lot longer. Now we're 30 points above. So we're not going to drop to zero overnight. It's going to be a process. And remember, we're already almost 5 months into an intermediate trend, and we've been parabolic in the move to the upside. We still got to get that kind of slowing move this direction, where the lines peak and flatten out before things really get dicey. So strong bullish trend. We follow the trend that we got. All right, now let's take a look at the intraday chart, and you can see we got higher high, higher low. We closed the week at the high of the week, closed the day at the high of the day, closed above yesterday's high, closed above. So we had this high on, what would that be, Tuesday, coming out of the weekend, where we got up to 280 and dropped down more than 3 points on an intraday basis almost immediately. Rallied back up through Wednesday and hit 280 again. Hit 280 on Thursday at the end of the day. Hit 280 early this morning and got above at the end of the day. So we got up to 280.41. Obviously, that's a new 4-week high point. In fact, if we were to go out now and take a little bit longer look at this, then we need to get rid of those Fibonacci lines. Let's get rid... Is that what the Fibonacci's argument? 1 second. Alright, so now I've got it all set up here. The 4-week range, so the high up here, the low, and you can see about a 13-point range, a very wide 4-week range. And you can see the low point here. We're not going to move for another couple of weeks. Well, 1, 2, 3, 4, 5. About a week and a half. We're not going to move that low point up. So no matter what we do up here at the top end, we're not going to start tightening the range with this coming down anytime soon. It's going to be another week and a half, which means, again, any kind of near-term pullback we get, if we stick around in this 273 area, which is right 273, 274 in that area right here, which is about the middle of this chart, as long as we stay up here, that's perfectly fine. Once you break through there, then we're getting a little bit more bearish, but not significant, because again, we don't typically start significant bearish moves until this range is tightened up again. Again, think about, you know, that curve where it starts to, where we parabolic up, and that extends the 4-week range, and then you start to curve, flatten out that curve, and then that will bring the range tighter, and then that's when you get more of the pullback. So that's where we're at. Now, if you take a look at that, you know, again, this near-term run, we talked about being a 5% move. One indicator that where you can see that charted out, here, let's go over here, and let's take a look at the rate of change indicator here. So let me see if I can find it. There we go. So the rate of change indicator down there at the bottom, and we're going to move this, whoops. We're going to move this to a 20-day period, and so we're going to switch this to a daily chart. So you can see, so a 20-day rate of change is 4 weeks. Basically, how much we've returned, how much of a return this is, well, not that one, this one. How much of a return this is from the beginning to now. You know, how big of a move that is. Not the low to the high, because the low occurred 10 days into this. But the beginning of the 4-week period to the high. And we're essentially at the low point at the beginning. So this rate of change indicator here charts that. And you can see, you know, we're up 5% over the last 20 days. About 5%, almost 4.8% over the last 20 days. The last time we were up anywhere near 5% in a 20-day period. So, right, you know, again, that's a pretty good annualized number. But the last time we were up that much was this February, and we peaked where we peaked in March. Again, where the intermediate trend started here, and then and then at the beginning we hit 5% at the beginning, right here, and that. You know, we still rallied, but we started to slow down. That rate of change came down to 0 as we flattened out. And then we had that last push higher. And then we really came down and had a couple of 20-day periods where we had negative returns. Well, that's where we're at now. Now, granted, in 2016, we had, you know, one period where we had a 10% move. But that was coming out. Typically your biggest rate of changes are coming off of significant lows, because again the VIX is much higher here, so you get a much sharper move over a 20-day period. And you remember too, the 20-day range is tight, or is wide to the downside, and when you come off those significant lows, you typically fill that range back up to the upside. And you can see again the same thing. Let's see, zoom out a little bit. Same thing here. We had a 10% move there. We were coming up off a minus 10% 20-day period. So big sharp move over a 4-week period of time. But then you can see, you know, those big moves lead to weakness, lead to some sharp weakness. Over here at the end of 2014, when QE4 or QE3 ended, we had about a 7% drop over a 4-week period. And we had a big, almost 10% move to the upside over 4 weeks, because again, VIX gets high back over here. VIX, you know, we're at that 5% move here. VIX isn't anywhere, obviously it's not high. And so again, This is a risk factor. Now, this isn't a risk factor to not be bullish. This isn't a risk factor to be significantly bearish. But it is a risk factor that, if you are looking to start trades now, let's say that, you finally feel confident to get into some positions and you've not been participating in this rally, now's not the time to put it all in. Put all your chips on the table. Now's the time to say, okay, we've been this bullish before, and that's led to, at best, a sideways move for a couple of months. And that, at best, occurred at the beginning of an intermediate trend. The last time we were this bullish at the end of one, we dropped. We dropped for the next 2 months. Considering that precedent, that's the risk factor that we need to account for in any new positions we enter in from today going forward, as well as with the positions we currently have where we have some decent profits in. So like that March 1st, again, we had another one of those days where we had 3 standard deviations of volume today, 150 million. The range wasn't as big, 1.25 points, one of the smallest range we've had. That's a little different than what we saw here in March where we had a big gap. We only had a 2-point range, but we also had a big gap there. So a little different there, but a small range coming at the end of this big move. A lot of volume trading hands today. You look at that here. Volume is off the charts from the 52-week range standpoint. 1.25 points is below the average, so you want it to stay this big. Considering that it hasn't been that small leading up to this, I wouldn't be surprised if we did get some volatility to the downside. But if we continue to get smaller moves, that's how you'll flatten out, right? With small volume and smaller moves. And then finally, the volatility index is, here, let's duplicate this because now you have a new low point forming here. And this one is your high point, essentially. So this one's going to be green. Put that one green. So you can see, obviously, we are pulling back, but we're not. Remember, we're at all-time highs in the S&P 500. We're not at all-time lows in the volatility index. So 11.25 is a lot higher than 9. The market's a lot more worried about pullbacks right now. It doesn't seem that way, but you can see from the VIX as well as the ratio chart here. We pulled back down, but we're not pulling back down below 80%, below 75%. Like we were at the early part of this year. We pulled back down to what was the top end of this bullish move and potentially could be the lower end of now a more volatile period right now that we may be entering in. All right, now let's go ahead and take a look at what's driving the price action. Of course, a reminder to on Twitter, for those that follow me on Twitter, and if you're not following me on Twitter, there's a lot of content. This is a great way for me to put out little pieces of content. It's considered like a micro blog. So if you're not following me on Twitter because you don't use Twitter, but you want to keep track of like stuff that Brandon and I put out, it's okay to create an account anyway. You don't have to tweet. You can just lurk and follow. And again, my address is twitter.com/DavidSettle42, /DavidSettle42. There'll be a button right here that says follow. And then at the top of pinned to my timeline is last night's or tonight's Market Outlook tweet. Make sure you like and retweet. We got to 114, so we're back up above 100 on my last one. I think Brandon got up over 100 too, or really close on his from last night. The goal is 150. Let's see if we can't cross that this weekend and get up above 150. And again, you benefit from doing it because Twitter will keep pushing you all my tweets. I benefit from you doing it because then they'll see that this is an engaging piece of content and they'll push it to all my followers to try to get them engaged as well. So that being said, let's take a look here at what's going on over the last couple of weeks, and you can see as bullish as we've been in the S&P 500, almost 5%, right, on that rate of change. Not as bullish in the small cap index. We're only up about 3.5%. But look at, so developed countries outpacing the S&P 500. Look at emerging markets, almost double the return as the S&P 500. Commodities, in this case crude oil, also up 10%, off its highs a little bit, but 10% move over a 2-week period. You can see the dollar struggling and crude oil struggling. And during this time where the dollar's been dropping from its highs, gold has made a run. But gold is even, up 5.5%, taking advantage of the weakness in the dollar. So right here, from this line going up, and including the S&P, really from this line going up, when the dollar is weak, this is your typical pattern here. International stocks outpace emerging markets and commodities, gold or metals, these crude oil and other types of commodity consumables. Those rally, and large caps typically do better because they're more exposed to that currency exchange. And when the dollar's down, people do better. Everything goes up in price when the dollar goes down. So that's your typical pattern. Now, typically, bonds don't go down and they didn't go down very much. As bullish as stocks have been, bonds are only down 1%. Long-term bonds. So that's actually not that bad. And they're barely underperforming high yield. High yield has not been confirming. In fact, on this last run here, you can see that the S&P 500 is done since let's go from the beginning. Well, no, from the 10th. From right about here, where we started this last little push higher. After that, the 1 day down that avoided the record close of 7 days in a row to start the year. You can see long-term treasuries have outperformed high yield. So high yield, we're up 2.5% since that low point on the S&P 500. High yield's not been matching that, and usually, this kind of goes hand in hand. Maybe not at the same amount, but they move together because the high yield performs similar, and high yield's been diverging away from this performance in long-term bonds during this last, or stocks, U.S. stocks during this last push. So another one of those kind of signs that we may be a little overextended. Now again, follow the trend. So I don't want you to think, well, David always is telling us to, that we should be out of this. No, follow the trend. I always say follow the trend. I'm pointing out the risk factors to try to keep you from being so aggressive in how you follow the trend. Because we're not at a point where the market's telling us to be as aggressive. And so I'm going to reiterate and point out these risk factors that will keep you from being aggressive. But that doesn't mean you have to be aggressively bearish either. And I want to make that point too. You don't have to be aggressive, right? One way or the other. And right now is one of those times where we're not really aggressive one way or the other. We're protecting, we're managing risk. We can buy really cheap protection that's getting a little bit expensive actually compared to a couple weeks ago. But we still, as an overall, follow the trend. And I think Brandon's tweets from his portfolio and his trend following class that he will be resurrecting here pretty soon for Market Scholars shows how important it is to continue to follow the trend, because that portfolio has been rocking it. All right, so with the sector rotation over that same 4-week period where we're up almost 5% on that rate of change, right, that really high result, you can see energy's been the biggest winner, and it was right from the outset and continues to be up 10%. So the energy sector, which we identified back here at the beginning of December actually as a sector that offered value because it had been so underperforming, but it's been starting to show some relative strength. It's really done well, outpacing a really bullish market by double. Consumer discretionary has always been one of the outperformers as well. Materials has been an outperformer, but it's been kind of pulling back a little bit towards the broad market recently. Industrials the same. You can see financials have been lagging, even with bonds down and yields up. Consumer staples has a positive return now. Not half of what the market's getting, but that's okay. Safe haven areas will get a smaller return, but they'll also be up above the broad market when you get a 5% move to the downside. So it's okay to see that, and you can see you have also real estate down 4% and utilities down more than 6% during a period when the market's been historically bullish. So you can see not everything is bullish, and of course that's going to be that's going to be opportunity. we should look at that as opportunity. Of course, this has been opportunity because there's been times where energy's been down there. That's been opportunity. Now, here's where we're going to find some opportunity. So if we're looking for a poster child of this crazy move in the markets, Kohl's, which is up 4% today, and not just today. You can see I'm on its all-time chart here. Down below, and the stock has split a few times back in the 90s. Down below is the rate of change thing I talked to you about earlier on the S&P for Kohl's over the past 20 months. There's a 20 period, and I'm going to start off on a monthly chart. So you can see for the first time since the 90s, Kohl's has had a 100% return over a 20-month period. So almost 2 years, 100% return. So you can see coming up off of below 35, getting up to now 70, where we've been before a couple of years ago in 2015. Okay, so that's on the that is on the monthly chart. So if you take a look at the daily chart, we're up over 25% over the last 4 weeks. Remember that 4-week period, that it's kind of that significant time frame on a shorter time frame basis that we look at. And you can see the chart is, you know, from 40 up to almost 70 since the end of the year. It's been a significant move. Obviously, if it's something that you're in, you can look for reducing that position. If you're something that you're not in, how in the world do you enter a trade on this or anything like this, since there are a lot of stocks like this that's pulling up? You can see, you know, again, if we were to say, okay, well, in the past when it's gotten 25% up, you know, it kind of runs out of gas. So but you know, the last thing we want to do is short this. So how can we make a very forgiving trade on this in case it were to hit this resistance and come down from this high 25% return over a 4-week period and start to slow down again, but not be something that needs it to go down significantly. So that's where, and you take a look at the options on it, and you can see relatively low volatility. It's not super low. It's at 36%. The 52-week low is 27%, and you can see it gets higher. So it's not super duper low, but you can see the trade I had up. If I were to say, okay, well, over February here, if this thing were to really start pulling back, what if we were to sell that 60 put? I'm going to sell a 60 put here. That's actually a bullish trade. Selling a 60 put for 45 cents. Not very much. Low delta, not very much money. You'll see why I picked that strike here in just a second. And to offset the risk on that trade, I'm going to buy a 60 put that's further out in March. So I'm going to right click on that bid price, hit buy, and this is called a calendar spread. And I'm going to buy that. I'm going to put it down to the regular March expiration, which is March 16th. So I'm selling a put with 28 days left, getting 60 cents. I'm buying that March put for protection against any potential crazy downside move because it's been such a bullish move. So a bullish move on the stock, bullish trade on the stock, selling the put, protecting it with a long put to the downside. Now, what does this look like? So when I analyze it, I put it in the Analyze tab. I'm gonna bring the, so you can see the date that we're looking at here is in February, because once we roll this, when February is done and we buy that back and we sell March to roll it, it closes out the trade. Now I can roll it to month after month to the next expiration and keep getting more credit and reduce that debit eventually down to nothing, as long as we stay above 60 or anywhere around here. But if you take a look at the slices, and I hit this break even on 217 and put them on the charts, then if you see here that here, let's pull up just the regular 3 green arrow charts. We can pull back, and in fact, actually I'm going to go out a little bit further. I'm going to go out to 10 years on this and go to a weekly. So look, so that's where my break is. It can trade anywhere in this range. Now, if it goes up, I'll lose money on the calendar because I'm losing money on that protection to the downside, that 60 put to the downside. But if it were to come down, you know, and start, I mean, look at this week after week. This only had one down week, but coming off that long lower shadow, which is always bullish, and then whammo to the upside. Big sharp moves to the upside. No long upper shadows. We did have one there at the end of the year, but since then it's been stellar. Rocket ship to the moon. But a lot of this year's move in the markets has been rocket ship to the moon. So we're looking to say, okay, if it were to come back anywhere in this range, I make money. Because as long as it stays above 60, let's go to the trade tab over here. And let's say that we get to, and I'm going to change this. Here, let's move this off. I'm going to change this to a Theo price. And let's reset that. Let's say we get to February expiration. So that's, and we get down to 60 bucks. So it goes down to 60 bucks. So you can see the February put is worthless. So there's nothing there's nothing left in this trade. But if I were to buy that back for practically nothing, a penny or two, and then roll it to the next week, February 23rd, then you can see I'll get about $1.30 in credit. Right. So now remember, it costs $1.20. The whole calendar costs $1.20. Now you also notice too that this March put 60 that I bought originally for $1.75 is now worth $3 because the stock has come down to 60. That protection is offering me some protection. So the short put's worthless because we didn't go below 60. This put now is worth $3. Now you remember again, if I roll it here to 60, if I roll it to this next one, whoops, to the February 23rd, so this 1 week expiration later, then I get another $1.30. If it bounces back up and stays above 60, great. Let's say instead of dropping to 60, it drops further. Let's say it drops down to 50, another, what was that? 7, let's say it drops $10. So it goes down to 57.5, not quite to that 55 level, which is where my other break even, but also not the best possible point either. So it gets down to that 57.5 area. So you notice now, again, go back to March 16th, and you'll see that that short put, because we dropped below 60, is now worth $2.45. And if I were to go out and roll it to this 60, so remember it was $2.45, this one's $2.87. So I'm getting 40 cents if I roll it to 60. Now it's got to get back up above 60, and let's say if it doesn't, it gets to the next week, so the 23rd, and it stays, right around here. Let's say it gets back up to 58.5, but doesn't quite get back above 60. So again, before it expires, that 60 now is going to be worth $1.45, right? So I'm going to buy that back for $1.45 and go out to the next week and say I can get $2.34. So about 90 cents more credit. So you see how, even though I'm still below 60 and I need to get above 60 to get that credit, but you can see how I'm just racking up the credits to help offset that cost of the calendar. Now during this time, my long put that I bought for $1.75 is still worth $3.36. So that's still offering me money. And let's say by the week after the March 3rd, it gets back up above 60. Let's say it gets 60.55. So now that if I wanted to, I can let that March expire worthless, that short put. It's done. And the long put will be worth 10 cents more than what I paid for it. So I get all that credit from all those short puts from rolling week after week after week while it's just kind of messing around here. And I get a little bit of money, my protection. Now, I don't really care if I make too much money, and this is just for protection. But you can see even that makes me a little bit of extra money if we were to come down and trade right around that 60 level. So you see, if we come down in this area, there's lots of opportunities to roll that 60 week after week and just get more and more credits, holding that long 60 in March until eventually I'm done with the trade, and then I can, hopefully I've made more in selling the puts than what I'm losing in that protection, and I'm able to get out. So, and again, this is all kind of like taking advantage of sharp, extreme move, markets maybe pulling back, the stock pulling back, and being able to profit from it in a wide, relatively, $10 range. So a relatively wide range that we can take advantage of. So needless to say, we are seeing a historic rally in the markets, and it doesn't necessarily mean that we have to short it. It doesn't necessarily mean that we have to, start new aggressive bullish trades either. We know it's going to end at some point. And if it does start to kind of waver and grind, and some of these stocks have really made an extreme move during that time, start to pull back, today's trade idea helps you to be able to take advantage of that without being too bearish, and with a forgiving trade that you can just keep rolling week to week to week. So, as always, thank you very much for watching. Remember to subscribe, like, and comment down below on the YouTube channel. Follow me on Twitter. Like and retweet tonight's Market Outlook tweet there. Let's get it up to 150 this weekend. And if you haven't already, join that Facebook community group. We're almost 800, just a few away. So if you haven't joined, join so you can continue in that conversation. So have a great one, everybody. Have a great weekend. We'll see you all on Monday.